Certainly, the outlook coming into 23 looks a lot better than it did going into 22. The indicators that I look at, looking at, say, 1 to 3, maybe 6 months out, are much more bullish now than they've been for quite a while, probably since mid 21. We've seen these kind of readings on the on the kind of risk on, risk off indicators that I look at. So that's a lot more positive. I think we're coming off of a period of heavy pessimism among investors and a lot of headwinds from the Fed in particular. I think that's a lot of that's going to ease, and as sentiment starts to improve, you've got the scope for equities to do better in the next few months. I think corporate earnings are the risks now. I think they'll be soft but not disastrous, and I think the economy is probably in better shape to withstand the Fed's rate hikes now than they would have been in past cycles. Certainly the 05, 06, 07 period, when last time we saw these kind of rate hikes. So I'm relatively positive compared to what I think the consensus has been. Not super bullish in the sense that think the economy is going to go through the roof, but I think equities can do better now, certainly in the first half of this year. So those indicators and kind of the more tactical macro market indicators are looking at both the trend and momentum in equities, which has certainly improved. Volatility has been coming down. Those are all tends to be good signs over the next few months. Also seeing things like credit spreads come in. So, cross asset, movements are supportive. And we're seeing things like industrial metals, some of the commodities that are sensitive to growth have picked up. Some of that is capturing the fact that, China is looking to try to reopen after being, heavily impacted by COVID and their real estate issues. So a lot of those things are things where they had been very negative and are getting, maybe less bad or picking up from low levels. And you see that in sentiment as well. The other thing, of course, is the Fed, where you've had, really heavy headwinds. The Fed has been aggressively trying to not just raise rates, but keep stocks from going up essentially for most of the last year. It looks like they're moving towards the end of that process. And we even actually saw the Bank of Canada doing that probably yesterday. Kind of moving to the sidelines. So I think February, March will be the last of the rate hikes, and that's showing up in the indicators that I watch as well, looking at the difference, say, between the 2-year Treasury and the 3-month Treasury yield as a measure of where the market thinks rates are going to be going. And that's gotten a lot better. So both the kind of macro interest rate, commodity backdrop, as well as the equity indicators themselves are looking a lot more favorable now and coming off of a really rough time, late last year. I think it's not necessarily that the economy is going to accelerate and go gangbusters again. It's more partly relative to what I think probably the expectations were over the last few months, that not as bad as expected is, in equity market terms, good. And also I think that there are offsets potentially globally. Europe is holding up better than expected. They may dodge a recession this year, which was not the consensus even a couple of months ago. China might stabilize at least and do a little bit better, which will help that region. So when I look globally at even at the earnings estimate revisions that I look at, they're negative, but they're more negative in the US actually than they are elsewhere, which is unusual. And I'm still seeing a cyclical tilt in some of the sector profiles of earnings estimates, meaning that the more cyclical sectors like financials or energy or industrials or materials, those are actually seeing somewhat better than average revisions, or at least less negative than average. Whereas the growth sectors, tech and communication services and so forth, and even some of the defensive sectors are seeing worse than expected revisions. So that all kind of tells me that it's not a purely defensive, economy's going into recession kind of profile. It's much more mixed, and therefore you have to, pick and choose. But I think there are some offsets to some of this. Partly some of the leftover from stimulus and the Inflation Reduction Act and some of the other, spending bills that have been put through that will take time to show up in data, but I think are relatively supportive. And so I think there's a little bit better fiscal support, at least for now. That may change because Congress is now split. And I think the economy is better suited to withstand the rate hikes than they were in the past cycles. And I think a lot of that's already happened in terms of housing and autos and things like that. Some of those interest-sensitive, markets have already responded to a large degree. And so if the Fed does pull back and long-term interest rates have already started to fall, mortgage rates have pulled back a bit, I think there's enough there to kind of balance things out so that you don't get, a severe recession. I think you get maybe a mild either recession or kind of, roughly zero-ish growth for a while, which is, again, not great, but not the end of the world. And so a bit of P multiple expansion will be enough to hold equities. There's a lot of mixed signals out there, and a lot of that is just the lagged effects of all the distortions and volatility caused by COVID and the response to COVID, and then Russia and then China. All of these major global shocks have thrown a lot of volatility into the macro data, both the real data and inflation, as well as earnings data. And so there's still a lot of things that are kind of the second order effects from that we're still seeing. And so whether it's, the tech stocks, a lot of them got, bid up in the equity market, but also got their earnings jump because of all the work from home. Now that's kind of starting to reverse a bit. Those winners from, COVID, which are also tend to be viewed as secular growers, but have now had to sort of go the other way. And some of the more cyclical areas that had gotten beaten up are now doing better. Now, yeah, you're right. I mean, the magnitude of the move in copper miners or home builders and things is not enough to offset maybe the weakness in Microsoft and Apple and some of those names like that, because they are having to adjust to both slower growth and the fact that they may have just overstaffed and kind of gotten too big, both in actual terms and in market cap terms over the last year or two. So I think you're seeing a rebalancing and kind of a relative movements between, say, value and growth and some of the sectors going on, and that's why Exxon is now back to being worth more than Tesla, and things like that you see that are more rebalancing than meaning everything is going down and it's a broad scale recession. So I think that's the important part is seeing this as rotation, and also just volatility in the numbers that we're going to have to just kind of wait for that to settle out a little bit to really get a better feel for what's really been going on, because even the employment data or GDP numbers are probably going to get revised substantially over the next 6 to 12 months, and we may have a different view of what's been going on lately. But I think if the situation in Russia, situation in China, and COVID all at least sort of stay stable or improve a bit, then I think some of those shocks are going to go away, and you're going to go back to sort of the slow but steady growth that we had prior to COVID. It's probably more the resuming that steady state as we go in the next year or two. The earnings story, kind of the backdrop, is become much more important now. Last year was more about the Fed and interest rates and the kind of the valuation compression because of that, and now this year it looks like it's going to shift from being kind of the Fed problem to being an earnings problem potentially. So yeah, I think earnings estimates for the S&P 500 for most stocks have come down pretty substantially already from where they were, say, even just a few months ago. And a lot of that has been driven by margin compression. So forward estimates of margins have come down quite a bit already. Because as you mentioned, sales estimates have actually held up relatively well for the index. And some of that is just the nominal, inflation kind of holding them up. But margin compression has been, pretty substantial already. Now, it could have farther to go in the sense that S&P index margins, at least on a forecasted basis, are still not quite back to where they were pre-COVID. They were just below 12%, I think, before, in late 2019. And now they're getting down to sort of the mid 12% range, 12.5% range, after having been as high as 13, 6 months or so ago. So there's definitely been a lot of adjustment already in that. I think there could be a bit more, but I think that even if stocks or the S&P only earns $200 a share, which would be below consensus, where consensus is now, I think the fact that the 10-year yields have already pulled back to 3.5% on the 10-year Treasury, and could go even somewhat lower if people think that the Fed will in fact start cutting rates either late this year or next year. I think that valuation could move in favor for equities. But yeah, my longer term model that you kind of alluded to, where I'm looking at the long-term, corporate bond yield adjusted for inflation, and compare that to kind of the longer-term outlook for, S&P real earnings growth. So after accounting for inflation, that model is actually still it shows low implied growth, meaning that people are expecting about zero real growth for earnings over the next, say, 10 to 20 years. Whereas I think kind of maybe 1.5 to 2% is probably a fair reading. And the actual trailing 20-year reading is closer to 4%. So I think the markets are already pricing in pretty low expectations for long run growth, not just this year, the longer term growth, and real bond yields after accounting for inflation and the fact that credit spreads have come down and that kind of thing still aren't really that attractive compared to what you could potentially get from stocks over the longer term. So when I see the tactical indicators that I mentioned earlier and this kind of longer term relative valuation indicator still showing pretty low long run real growth expectations, meaning it's a very low hurdle the market's putting on growth right now, then that's usually a pretty supportive backdrop. And actually, we've seen stocks outperform bonds most of the last, 6 to 12 months, even though neither has done that well. On a relative basis, stocks have actually held up better, which is unusual. Usually when interest rates go up this much, stocks lag, and they haven't, because you've got this sort of distortion, or this gap in earnings versus bond yields, and that's still relatively favorable in my work for stocks. So I think longer term, stocks still look better than bonds. I think maybe neither one of them will do super well in the sense of meeting their long run returns, average returns. But I think stocks are still a better place to be, at least for a while now, than bonds based on relative valuation.